Have you ever wondered how to make your money work harder for you and achieve your financial goals? Well, investing in dividend stocks and exchange-traded funds or ETFs might be the answer you're looking for. But what exactly are they? Dividend stocks are shares in companies that distribute a portion of their earnings back to shareholders on a regular basis. On the other hand, ETFs are a type of investment fund that's traded on stock exchanges, much like individual stocks. Now you might ask, why dividends? The answer lies in the potential for consistent income and long-term wealth accumulation. And why ETFs? Because they offer a chance to diversify your portfolio with a single purchase. Together, they can form a powerful combination for your investment strategy. So are you ready to dive into the world of dividend investing? Let's begin. First up, we have blue-chip dividend stocks. Now, what are blue-chip dividend stocks? These are the shares of large, well-established, and financially sound companies that have a history of reliable and consistent dividend payments. They are the titans of their respective industries and have stood the test of time. Think of them as the cornerstones of the investing world. Companies like these have a proven track record of stability and success, demonstrating resilience even in times of economic downturn. Their long-standing presence in the market and their established reputation often make them a safe bet for investors. So, what's the benefit of investing in blue-chip dividend stocks? Well, besides the obvious potential for capital appreciation, these stocks provide a steady stream of income in the form of dividends. This can be a significant advantage, especially for those who are looking to generate a consistent income from their investments. But that's not all. Blue-chip companies are known for their ability to maintain or even increase their dividends over time. This means that not only can you rely on a steady income, but there's also the potential for this income to grow over time. Investing in blue-chip dividend stocks is a strategy that has the potential to deliver both stability and growth. It's a method used by many seasoned investors who appreciate the balance between risk and reward. So investing in blue-chip dividend stocks is like betting on a tried and tested player. Next, we delve into the world of dividend aristocrats. Picture a royal court of stocks where these aristocrats sit atop the hierarchy. Their crown jewel? A consistent increase in dividends for at least 25 consecutive years. This consistency is no small feat and signifies financial strength and stability. Dividend aristocrats are often part of the S&P 500 index, representing some of the most well-established companies across various sectors. They are the financial equivalent of a marathon runner, not sprinters, displaying endurance and reliability over a long period. The real allure of these aristocrats lies in their dual reward system. On one hand, they provide steady income through regular dividend payouts. On the other hand, they hold potential for capital appreciation. Over time, as these companies grow and succeed, so too does the value of their stock. However, like all investments, dividend aristocrats are not without risks. Even these stalwarts can face financial hardships that may force them to cut dividends. But due to their history of resilience and growth, they are often viewed as safer bets in the dividend investing arena. So if you're an investor seeking a blend of regular income and the possibility of long-term growth, these aristocrats may deserve a place in your portfolio. Remember, the key is to thoroughly research each potential investment to understand its financial health, growth prospects, and dividend sustainability. Dividend aristocrats offering a mix of income and potential capital appreciation. Now, what about those attractive high-yield dividend stocks? These are the stocks that catch your eye with their higher-than-average dividend yield. They promise a bigger piece of the pie, a chance to maximize your income from your investments. But as with all things that glitter, they may not always be gold. High-yield dividend stocks can be a great source of income, particularly for those looking to generate a steady cash flow. However, a high yield isn't always a sign of a sound investment. Sometimes it can be a red flag indicating a company that's in trouble and trying to attract investors with a juicy dividend. So how do you separate the wheat from the chaff? The key lies in thorough research. It's essential to understand the financial health of the company you're investing in. Look at their earnings, their debt, their cash flow. Are they making enough money to sustain that high dividend? Or are they paying out more than they can afford, potentially jeopardizing their future growth? Also, consider the sustainability of the dividend. Is the company in a stable industry with consistent earnings, or is it subject to cyclical fluctuations that could impact its ability to maintain that high yield? And remember, diversification is your friend. Even if you're chasing high yields, don't put all your eggs in one basket. Spread your investments across different companies, sectors, and even countries to mitigate risk. High yield, high risk? It's crucial to know before you go. Moving on to dividend ETFs, a popular choice for diversification. Dividend ETFs, or exchange-traded funds, are investment funds traded on stock exchanges. They're designed to track and replicate the performance of specific indices, sectors, commodities, or investment strategies, in this case, dividend-paying stocks. One of the key attractions of dividend ETFs is diversification. Instead of putting all your eggs in one or two companies' baskets, you're effectively investing in a broad portfolio of dividend-paying companies. This reduces the risk associated with individual stock ownership and provides a level of stability to your investment. For instance, the Vanguard Dividend Appreciation ETF, or VIG, focuses on companies that have a record of growing their dividends over time. This ETF includes top-tier companies, thus providing a solid foundation for your investment. Similarly, the iShares Select Dividend ETF, known as DVY, targets companies with a positive dividend payment history. It's another great example of how dividend ETFs can provide a stable income stream while minimizing risk. Apart from these, there are also sector-specific dividend ETFs. These ETFs concentrate on sectors known for stable dividends, utilities, real estate, or consumer staples, for instance. They offer the opportunity to tap into the consistent performance of these sectors while receiving dividend payouts. If you're looking for growth and income, dividend growth ETFs may catch your interest. These ETFs invest in companies that not only pay dividends, but have a history of increasing those dividends over time. The ProShares S&P 500 Dividend Aristocrats ETF, or NOBL, is a prime example. Lastly, for those who seek higher yields and diversification, emerging market dividend ETFs offer a compelling choice. These ETFs focus on dividend-paying companies in emerging markets, potentially offering higher returns. In essence, dividend ETFs come in all shapes and sizes, catering to different investment goals and risk appetites. Whether it's sector-specific ETFs, dividend growth ETFs, or those focusing on emerging markets, there's likely an ETF out there that fits your needs. Diverse and dynamic dividend ETFs offer a range of interesting options. Ever heard of DRIPs? No, not from a leaky faucet, but from your investments. Dividend reinvestment plans, or DRIPs, are a valuable tool offered by many companies to their investors. If you're new to the term, let's break it down. In essence, a DRIP allows you to automatically reinvest your dividends to purchase additional shares in the company. Instead of receiving cash dividends, you're buying more of the company's stock. The beauty of this plan lies in the power of compounding. As you reinvest your dividends, you acquire more shares, which in turn generate their own dividends, leading to a snowball effect of growing wealth. Over time, this can significantly increase the value of your investment. Remember, successful investing is not just about instant gratification but also about long-term growth, and that's where DRIPs come into play. DRIPs, a smart way to reinvest and compound your dividends. Before diving in, here are some key factors to consider. Firstly, when investing in dividend stocks or ETFs, it is crucial to analyze the dividend payout ratio. This ratio is calculated by dividing dividends by earnings. A low payout ratio can be a positive sign, indicating that the company has ample room to increase dividends in the future. However, if the ratio is too high, it might mean that the company is distributing more than it should, which might not be sustainable in the long run. Therefore, a careful analysis of this ratio can provide valuable insights into the company's financial health and future prospects. Secondly, diversification is of the essence. It's not just about spreading your investments across different stocks or ETFs, but also about diversifying across various sectors and industries. Over-reliance on a single sector can expose you to specific industry risks, which could be detrimental to your portfolio. So, whether you're investing in blue-chip stocks, high-yield stocks, or sector-specific ETFs, remember to diversify. It's a fundamental rule of investing that helps to reduce risk and increase potential returns. Thirdly, regular monitoring of your investments is paramount. Companies may change their dividend policies, and economic conditions can impact dividend payments. Therefore, it's crucial to keep an eye on the performance of your dividend stocks and ETFs. Regular review will allow you to spot any changes early and react accordingly, whether it means holding on, selling off, or buying more. Investing is not a set-and-forget game. It requires active management and regular reviews. Last but not least, tax considerations should not be overlooked. Dividend income may be taxed differently in your jurisdiction compared to capital gains. Some dividends may even qualify for lower tax rates. Therefore, it's highly advisable to understand the tax implications of your dividend income. Consult with a tax advisor if needed, to ensure that you're not caught off guard when tax season comes around. In conclusion, investing in dividend stocks and ETFs can be a rewarding strategy if carried out thoughtfully. Remember to analyze the dividend payout ratio, diversify your investments, regularly monitor your portfolio, and understand the tax implications of your dividend income. These factors will not only help you make informed decisions, but also enhance your potential for success in the world of dividend investing. Remember, knowledge is power. The more you know, the better you grow. And that, dear viewers, is a crash course on dividend investing. We've journeyed through the world of dividends, exploring the enticing avenues of blue-chip dividend stocks, the stalwarts of the market, known for their stability and consistent dividend payments. We've discovered the impressive dividend aristocrats, those companies that have proven their mettle by increasing their dividends for at least 25 consecutive years. Their commitment to shareholders represents a blend of income and potential for capital appreciation. We delved into high-yield dividend stocks which, while potentially rewarding, require careful research to ensure the company's financial health and the sustainability of the dividend. And let's not forget the world of ETFs, those baskets of stocks that allow for diversification and exposure to different sectors and industries. We've looked at examples like the Vanguard Dividend Appreciation ETF and the iShares Select Dividend ETF, as well as sector-specific and emerging market ETFs. We've also explored the power of dividend reinvestment plans, a tool to automatically reinvest dividends, allowing your investment to compound over time. We've discussed the importance of analyzing the dividend payout ratio to ensure a company's dividends are sustainable and have the potential to grow. Diversification, too, is a key element of a successful dividend strategy, reducing risk by spreading investments across different sectors. And of course, we've touched on the importance of regular monitoring, understanding tax implications, and the necessity of aligning your investment strategy with your financial goals, risk tolerance, and time horizon. But remember, all these investment strategies, while potentially fruitful, require thorough research or consultation with a financial advisor before making any decisions. Investing, after all, is not just about making money, it's about making informed decisions that align with your financial goals and risk tolerance. Remember, investing is not a sprint but a marathon. So take it slow, do your research, and may your investments bring you fruitful returns. Before we wrap up this insightful journey into the world of dividend investing, if you found this video helpful, enlightening, or even just a little bit interesting, we have a small request. Don't forget to hit that like button. It's a small gesture, but it means the world to us. It also helps other investors like you find our content. And if you want to stay on top of your investment game with more insights like these, be sure to subscribe to our channel. We're constantly researching, analyzing, and creating content to help you make informed investment decisions. We've got a wealth of videos on various investment strategies, market trends, and financial tips that could be the key to unlocking your financial potential. So don't miss out, subscribe and join our community of savvy investors. Thank you for watching, for your support, and remember, happy investing.